Got a video today on how life insurance premiums work, base premium, paid up additions, term riders, reduced paid up, all these different terms you might have heard. I want to explain how those work, how the entire premium works, and what we're really trying to accomplish inside of these high cash value, infinite banking concept policies. Now, there's really the three parts, like I mentioned, inside of this premium. There's what we call the base premium. There's what's called the PUA, or paid up additions. And then the next part here is called a term rider. And all three of these pieces, not always the term rider, but these are the pieces that make up a high cash value life insurance policy. And understand, different companies will have different names for these same pieces, but they're all going to be relatively the exact same. Now, all of these together make up what's called our premium. So oftentimes I get questions about, can I put in more money than the premium? Understand that any money you put in is considered premium. So you can only put in money that's premium because all money that goes in is premium. And usually what people are asking when they say that is they're asking, can I put in more money so I can have more cash value? And that's where these come in. Now, in every situation, these different pieces are going to vary. What's the ultimate goal here that we're trying to accomplish? Well, these pieces all go together for us to get one thing, and that's called our cash value. That's the real goal here. And it's funny to me. I get people that I talk to, they read these books and they come to me and they say, hey, can I get more PUA, or can I have more base insurance? And that's all great. I'm glad people educate themselves, but understand that all these pieces only matter so far as we're getting our outcome that we want, or the cash value, which is the ultimate goal here, is just the outcome. We're going for outcomes here. So each of these pieces, when I set this up for a client, it's being set up so that we get the outcome that we want. I don't really care how these pieces fit in so much, as long as I'm getting the outcome that we want. And the way I do that is with software, and I tweak things and I mess with things, but ultimately the software is telling me, because I know how to use it properly, how to get the particular outcome that I want. And what that is cash value and cash value growth over time. So now that being said, there is one other piece to this that really matters, and that's up here, and that's called the MEC line. So what we're doing, and what I'm doing in these policies, is the MEC line is the limit to how much we can put in to keep this taxable. It's also, oftentimes, the amount of insurance that you're actually buying. So what we're doing inside, and what I'm doing inside these policies, is I'm pushing this MEC line so that I can get more cash value in, and I'm also lowering it so that I have less insurance so that I can have more growth. So it's a delicate balance. Like I said, in the end, these pieces go together so that we can have a tax-free account that's going to grow tax-free, transfer with no income tax, have all the major benefits of cash value and growth, while at the same time getting the outcome that we want. Now, that's the other part of this that matters. Some people want more cash early on so they can invest it and so they can do things with it. Other people are willing to forfeit cash up front so that they can have more long-term growth. That's also another balance, or another way that we can tweak these policies. Once again, every person is different, and it depends on the outcome that we're trying to accomplish. Now, I want to talk a little bit about this base premium part, because that's usually where the money's going, and also into the PUA. But I want to talk about our options that we have inside of a life insurance policy. Because oftentimes I get people saying, oh, well, what happens if I don't want to make any more payments, or I don't want to put any new money in, I don't want to pay any more premiums, or what if I get into hard times? Life insurance has some great adjustable options. We can always adjust lower and put more or less money in up to our maximums as we want. But there comes a point in time where you may want to retire, or where you just can no longer afford to put premiums or money into the policy, and you want to forfeit the right to put in new money in order to have the majority or the most growth possible. So I want to explain a little bit about how life insurance works. When you buy a life insurance policy, you get a certain amount of death benefit. And like I said, I'm talking mostly about the base policy here. The other pieces matter, but it's important to understand this from the core insurance perspective. So what we're going to have here is, let's say we have year one here, and at the end of this line, it varies in policy to policy. Some policies go to year 100, some policies go to year 65, some go higher, some go lower, but let's just say this policy ends at year 65. And let's say that this is a $500,000 policy. Well, as long as we're putting in new premium, we're always going to have this $500,000. But what this is saying is that as long as you pay your premiums until you hit year 65, you're going to have $500,000. And at the end of this road, at year 65, you no longer have to put in premium dollars, and you're going to have this $500,000, and it'll be permanent, and it'll be on you until the day that you die. But what happens in between here if you decide you don't want to put in new money anymore, you can't afford to, or you just simply don't want to, maybe you retire early or something happens? Well, it's not an all or none scenario. What is actually happening is this is what's called paid up. When you hit 65 years old in a 65-year policy or a 65-pay policy, pay to 65, at year 65 it becomes paid up. Now, every year as you go along through your life, you're actually paying up more and more of this $500,000. So let's say that you're paying into this policy, and when you hit 30 years in, let's say he's 50, let's say he bought it when he was 20, and 30 years in, he's got $300,000 of paid up insurance. And he decides he doesn't want to put any more money into this. We can always exercise this option, and that option is called the RPU, or reduced paid up. And so now that you kind of understand what paid up means, I think it can be a lot more obvious what reduced paid up means. Reduced paid up merely means that we are reducing the death benefit down to what we have been paid up today, and we are no longer going to put premiums into this policy, and now this policy will grow with its maximum and continue to get its most, the best benefit, the best dividends. As long as we're paying in the premiums to get this $500,000, we're going to be getting the best benefit from this policy if we're putting in money. But if we stop putting money in for a long period of time, it might affect our interest earnings over the long period by a little bit. So what we do in this situation is we make a reduced paid up policy. In order that we can continue to let the policy grow, we can still take loans and pay those back, but the policy is now going to grow with the best dividend possible for the rest of your life. It's going to continue to buy you life insurance at the paid up rate. It'll continue to grow with the paid up additions and all the other little pieces of it. But understand, and really the whole point of all this is that you do have adjustability. If something does happen, we can always lower or completely eliminate premiums. And the last thing I want to say is, look, if you are in one of these policies and you are getting to a point where you feel like something needs to change, or you do need to make a reduced paid up, or you want to see what this option looks like, talk to a professional before you make that kind of a decision. It is a permanent decision, and it needs to be discussed with what your future goals are, etc. But like I said, this is just to show you that life insurance has complete adjustability. We can exercise this option at any time throughout the policy. So once we buy a policy, we're not locked into anything. We do have a lot of room to give and to make good decisions so that we can get the best outcome in these policies.